Assalamu alaikum friends, welcome to part 3 of IFRS 3 and this part we'll be talking about impairment of goodwill. Impairment I have covered when I was discussing IS 36 impairment of assets. But here specifically we're talking about goodwill that we have acquired during our business combination. Okay, so for that impairment we are using IS 36. Okay, so we all know that goodwill does not generate independent cash inflows. Okay, through goodwill we cannot generate revenues independently. Therefore, it is tested for impairment as a part of cash generating unit. They cannot generate independent cash inflows. That's why when we are testing it for the impairment, they are taken as a part of cash generating unit. Okay. What is cash generating unit? I have explained this in IS 36. Again, you can go through this definition, right? If you want, this is the definition. Okay. For exam purposes, a subsidiary is normally designated as a cash generating unit. So this makes your work very easy. The subsidiary is a cash generating unit. You don't have to worry about cash generating unit, how to allocate between all those things, okay? When it comes to IFRS 3, when it comes to group accounting. Because for group accounting, when you have to impair the goodwill, there's a subsidiary, right? We are not given cash generating unit like how we are given under IS 36 that okay, this is the goodwill, this is the assets, so the impairment loss you allocate first against goodwill, then against other assets on a pro rata basis. No, when it comes to subsidiary itself is taken as a cash generating unit. Okay, so now how do we account for that impairment? Rest all everything remains same. Whatever you have studied in IS 36 that your carrying amount should be greater than recoverable amount, here also is the same principle. Okay, so impairment losses carrying amount is more than the recoverable amount. Carrying amount of an asset or a cash generating unit exists as recoverable amount. It could be an asset also, it could be a cash generating unit also. In this case, it is a subsidiary. Subsidiary is asset, that means the goodwill. So the carrying amount is more than the recoverable amount. The recoverable amount also same like IS 36. Higher of the fair value less cost to sell or value in use. Okay. How are you going to deal with the impairment losses if it's on a subsidiary? This will be first allocated against goodwill. Same like how you have done for IS 36 when you are allocating the impairment loss. Here also it is the same. Okay, first against goodwill, then against other assets on a pro rata basis. So how it's done on a pro rata basis and how against goodwill or not, please go back and check IS 36. It is explained in detail there. Now we are going towards the two main things, accounting for an impairment with NCI. Because NCI earlier, the part 2, I told that NCI you can measure using two methods. One is fair value, one is proportionate method. Because of this goodwill changes, and because goodwill changes, impairment will be changing. In one, you'll be finding a higher impairment, the other one will be giving you a lower impairment. Can you tell me which out of these two methods, without reading anything or without me explaining you, which of these two methods will give you a higher impairment loss and which will give you a lower impairment loss? Just think. Common sense would do this. Yes, if you are saying that a high impairment loss is under the fair value method, then you are right. Why? Because under fair value method, the goodwill is allocated for both the parent as well as the NCI. That means higher goodwill is recorded under fair value method. Because the goodwill is higher, impairment loss also will be higher. So based on that logic, it's higher impairment under fair value method. Okay. So sometimes they might not say fair this or this. They might tell you calculate under full goodwill method. That means fair value only. Make sure that you know those words interchangeably. You know, it's the same thing. Okay, and goodwill you have to add this together with other net assets of the subsidiary and then compare to the recoverable amount of the subsidiary's net asset. They will give you the recoverable amount, or at least they will give you the fair value less cost to sell and the value in use to find out whichever is high and then take that as a recoverable amount. Okay, so goodwill you add with other net asset, then compare with the recoverable amount. Okay, on a like for like basis, any impairment of goodwill is allocated between the group and the NCI based upon their respective shareholdings. We know that when it's a fair value, allocate between the group and the parent. Even the impairment of goodwill will be allocated. If group is 60, NCI is 40. So 60% of impairment for group, 40% of impairment for NCI. When is NCI the proportionate method? How do you do that? This is known as partial goodwill method. Okay, not full goodwill method. Then only goodwill which is given to the group, that means to the parent, is calculated. NCI share is not reflected in the group accounts. So when you are comparing the carrying amount of the subsidiary, including goodwill, right, with the recoverable amount, it is not on a like on like basis, because that goodwill is only taking the parent. You have to take the NCI also when you are comparing with the net asset. So what should you do? You should do this additional working is required when it's a proportionate method. So to address this problem, you gross up the goodwill. You gross up the goodwill. It is known as grossing up goodwill. When you are grossing it up, then you are including both the parent's NCI as well as the parent's goodwill as well as the NCI's goodwill. Okay. Before you conduct the impairment review, you should gross up. Remember that. Prior to, okay. So this grossed up goodwill is known as what? Total notional goodwill. So we definitely have questions on this. Okay. As only the parent share of the goodwill is recognized in the group accounts, only the parent share of goodwill impairment loss should be recognized. Remember, in the group accounts, you are only recognizing the parent share of goodwill. Okay, this you are grossing it up to calculate the impairment review. Okay, but when you are taking the impairment loss to recognize in the group account, only the parent's share of goodwill impairment loss should be recognized, not the NCI. Remember that two things. Okay, you are not taking the gross up figure here. Gross up figure is only to find the impairment review. That's it. That is the only job, to gross it up. Next, you are only taking the parent share of the group's impairment loss and writing it in the profit and loss account. Okay, under expenses. And now, before I officially start doing the questions and end this video, let me take you to the through some criticisms of IFRS 3. There are some criticisms of IFRS 3. Okay. So this are it's like some issues, some problems with IFRS 3 relating to some specific items. Number one, fair value. Okay. Because everything we have to calculate fair value. The assets, the liabilities, right, of the subsidiary. So it makes it difficult to compare entities that grow via acquisitions with those that grow organically. When you're taking two entities, one entity is growing by acquiring with other entities. So they are calculating fair value. But what about those entities who are growing organically? They are not acquiring anyone. There they are not taking fair value. So then it becomes very difficult to compare the two entities. You see? Second, recognizing the inventory of a subsidiary at its acquisition date fair value will reduce the profit margins in the next period, thus reducing comparability year on year. Because inventory is also part of an asset, so that also you have to recognize that fair value, right? So because of that, profit margins are reduced, and that enhance comparability. Next, we have intangible assets. IFRS 3 requires entities to recognize separable intangibles at fair value, right? Everything is at fair value here at the acquisition date. But this is difficult and judgmental if no active market exists. They are saying, okay, do fair value of intangible. But we know through IS 38 that intangible assets, not all has a active market. So it becomes very difficult to get the fair value of intangible assets which does not have an active market. Okay. Coming to the contingent consideration. Here the calculation of fair value is subjective. Okay, that means your risk of bias will increase and comparability also will reduce. Okay. Next, contingent consideration may be linked to the success of a long-term development project, right? Contingent means it is based on something. If some conditions are satisfied, you are giving that consideration. So this might be linked to the long-term success. So it could be argued that the changes in the fair value of the consideration in such scenarios, okay, should be recorded against the development asset rather than profit or loss. It should be recognized rather than profit or loss. That means changes in the fair value, because where do we recognize changes in the fair value? In the profit and loss account, right? Normally. But here they are saying in this condition it has to be recognized in the recorded against the development cost. That means you're deducting it from the development asset. Okay. Changes in the fair value of what? Not the development of the consideration. Because let's say your consideration you'll be paying in 5 years. If in 5 years you can develop a project, right? So in those 5 years fair value will change every year, so that there will be some changes in the fair value. You do not recognize it in profit and loss, but you deduct it from your development asset, the changes in the fair value. Okay. Coming to goodwill, some say that the gain on that bargain purchase, that means the negative goodwill, they should not be recognized in profit or loss, but rather it should be recognized in OCI. Okay. But this distorts the performance profile of an entity if they do so. No, because they think it distorts the performance profile of an entity if you recognize it as a gain in the profit and loss. It distorts the performance. Remember, these things, even though they might not ask you as a theory question, but this might come as a current issue. They might ask you. Because in current issue, what happens? They always ask questions on the criticisms of some standards, right? And which projects are developing to overcome those problems. So this, as a current issue, this they might ask these questions. So it's better that you know this area as well. The criticisms of any standard. Next, goodwill impairments are complex, subjective and time consuming also. Okay. Next, performing annual impairment reviews in respect of goodwill rather than amortizing it increases volatility, right? Because we are not amortizing goodwill. We don't amortize goodwill, right? We are just carrying annual impairment review. Next, over time purchased goodwill will be replaced by internally generated goodwill. So according to IS 38, internally generated goodwill we do not recognize. We do not recognize it as an asset. So as such, some argue that purchase goodwill should be, that means whatever goodwill you have calculating when you are purchase goodwill, the goodwill that you have got it, that you have bought it, should be amortized. But because we don't amortize goodwill, we amortize intangible assets which has definite useful life, but we do not, even though goodwill is a part of an intangible assets, we do not amortize it, right? We check for annual impairment. We do annual impairment review on goodwill rather than be subject to annual impairment review. Coming to NCI, the last one is NCI, allowing a measurement choice, fair value versus proportionate share. This reduces comparability. Again, comparability issue is there because some firm might be doing fair value, some might be calculating as a proportionate share, right? So measuring the fair value of NCI can be problematic, right? And highly judgmental if the entity is not listed, because we know that when an entity is listed, finding fair value is easy, but not when it is not listed. So that's it. Now we'll be doing questions on this impairment of goodwill before I summarize the whole IFRS 3. So let's start with test your understanding. But before doing test your understanding, let me illustrate this through an question. A owns 80% of B. That means as a subsidiary. At 31st October 2006, the carrying amount of B's net asset is 60 million. excluding goodwill, okay, of 8 million that arose in the original accusation. The recoverable amount is 64 million. Discuss the implication of recoverable amount of the net asset of B if NCI is measured at fair value, if NCI is measured using the second method. So here, according to impairment, okay. So all those things, I'm not going through this, that impairment has to be carried out, if it is more than this and this and this, all those things are not needed now. We are directly going to the answer, okay. So if it is, we are first recognizing goodwill, which is 8. We are adding this with the net asset 60, because fair value, just give me, it is 60. Yeah, it is 60, excluding goodwill. So you have to add that goodwill with the net asset, okay. Then recoverable amount is 64. So recoverable amount is less than carrying amount, impairment is 4. And this will be allocated against goodwill, reducing it from 8 to 4. Okay. This impairment loss will be first allocated against goodwill. So how much goodwill we have? 8. So it will be reduced from 8 to 4, because 8 minus 4. So what about the balance? The 4 million impairment expense. This will be charged to profit and loss. And of this is the parent, okay? For 4 million of 80%. This will be attributable to the group, and the 20% will go to the NCI. Because this is fair value method, so you have to show how much it will be attributable to the group and how much of it will be attributable to the NCI. Okay. Next, if you are using the proportional method. Okay. Then we have to take the notional goodwill. Remember, this 8 is not the full fair goodwill, so we have to notional. How are we taking notional? On this 8 million, whenever we have to gross it up, it's 20 over 80. Remember this percentage. Why? Whatever is the NCI percentage, it is 20 over the balance. 100 minus 20, 80, not 20 over 100. That means you are taking 20%. You are not taking 20%. Okay, it will be 20 over 80. If the NCI was 30, then it will be 30 over 70. This is how it goes. So you add this. So this is known as a total notional goodwill. And net asset remains 60. So this is now your carrying amount, your recoverable amount is this, and this is your impairment, which is higher now. Okay, and this, so the impairment loss is allocated against the total notional goodwill of 10 million, remember, not again the goodwill 8. Okay, it will go against this 10. So that means you'll be left with 4 now, right? And here only the group share of goodwill will be recognized in the financial statements. And group share is 80%. So 80% of the impairment is recognized. So the impairment charge to profit and loss will be 4.8. That means 8 minus 4.8. And the goodwill will be reduced to 3.2. 8 minus 4.8. From 8, okay, remember, this 8 is the parents. Okay, so from 8, you have to deduct the impairment which is allocated to the parent, which is 4.8. Okay. Because if you're finding how 4.8, it will be 6 million into 80%. Okay. On this only you have to find out this impairment, 6. So that's it. Now let us go through test understanding 11. 1st Jan 2005, he purchased 80%. That means NCI is 20% for 500,000. This is the consideration, purchase consideration. Net asset is also given the fair value at the date of acquisition to 590,000. Just a minute, I just want to go through illustration to see something. Okay. The carrying amount of net asset is 520. This is excluding goodwill. Okay. And happy is a cash generating unit. And the recoverable amount is 530,000. Calculate NCI if the fair value is 130 and the other one is the second method. Okay. So if it's full goodwill method, fair value of consideration paid plus the fair value of NCI minus the net asset. Goodwill is 40. Okay. So when you are taking the impairment review, how are you taking the impairment review? This is impairment review you have to take, okay? With goodwill, you have to add net asset. Goodwill is 40. This 40 you are taking here, and net asset. Okay, net asset already we have taken here 520. And recoverable amount is 530, so the impairment is 30. Okay. Just give me a minute. Carrying amount of net asset is 520 excluding goodwill. Okay. So that's why we have to add that goodwill with this carrying amount. This is the carrying amount. Recoverable amount is 530. Impairment is 30. Okay. And this impairment will be allocated against goodwill. So goodwill is how much? Goodwill, if you have calculated, it is 40. That means 40 will be reduced to 10. 40 minus 30. And the 30,000 impairment expenses is 30,000. This will be charged in the profit and loss. Okay. Out of this impairment, 80%, that means for the parent, that means 24,000 will be attributable to the group. The balance 6,000 is for the NCI. Coming to the proportionate method, this will be same as above. Here you have to take this. On the net asset, you have to take 20%. And net asset remains the same. Rest all remains same. Goodwill is now 28. You have to gross up because proportionate. So when you're grossing it up, it's now 20 over 80. Okay. On 28. So 7. Now add this 7, which is 35. This is your net asset. So carrying amount is this. Take your recoverable amount. Impairment is 25. Then this will be allocated against the notional goodwill. Because this is only the group share of goodwill that will be recognized. So only the group share of impairment is recognized. If the group share of goodwill is recognized, when it comes to impairment also, only the group share of impairment is recognized. Okay. So what would be the total impairment that will be recognized? 80% of 25,000, this impairment. Okay. And this will be charged to statement of profit and loss. Coming to 12. Okay. Extracts from the statement of financial position. So you have been given some extracts of 3 companies. Let us go to Sonia and Akther. Okay, Sonia. On 1st of April 2007, Polo acquired 6 million of Sonia's equity share and exchange for by an exchange of 1 share in Polo for every 2 shares in Sonia plus 1.25 per acquired Sonia share in cash. This is not normal cash consideration. They have shares also here. Okay. The market price of each Poland share at the date of acquisition was 6 and the market price of each Sonia share was 3.25. Cash consideration transferred for the acquisition of Sony has been recorded by Poland in a separate financial statements. But the cash consideration has not been recorded. In addition, 1 million of the professional costs relating to the acquisition are included in the cost of investment. Remember that there will be sometimes errors also, okay? Don't take as it is. Just because they have taken that 1 million in the cost of investment, it is not correct. So you have to take it out. At the date of acquisition, Sony had internally generated brand that was unrecognized in separate financial statements. So the directors estimate that this brand has a fair value of 2 million and indefinite life. They have a policy of valuing NCI at fair value. For this purpose, the share price of Sony should be used. Impairment test concluded that recoverable amount of net asset was 34 million. Coming to the Akther. Okay. On 1st of April 2007, he acquired 30% of equity shares at a cost of 7.5 per share in cash and recorded this in a separate financial statement. That means this is not a subsidiary, this is an associate. Required. Discuss how to determine the carrying amount of the goodwill when you are acquiring the Sonia and how it will be reported in the consolidated statement of financial position. Very simple question you will be getting in your exam, right? This is how you will be getting your actual questions in your exam. Discuss how to account for the investment in Akther. This is an associate. And prepare the not current assets section of the consolidated statement of financial position. Only this section they have asked. Don't make the full consolidated statement of financial position. Okay. So now let's see how it has been prepared. So I'll be going a little bit slow here because this is a long question and you might feel lost somewhere, you might get confused. So in order for you not to get confused, I will be going slow and one by one I'll be taking. Okay. So let's start with the consideration. Consideration must be calculated at fair value. We know that, right? So now starting with the shares, we have to find out how many shares Poland has issued. Poland has issued 3 million shares. Why? Because they'll be giving one for every 2 shares. That means half of 6 million, which is 3 million shares. And this is valued at 6 each, which will give you 18 million of share consideration in the goodwill. And share consideration, it will be included in the goodwill calculation. See, it does not matter what type of consideration it is. It could be share, it could be cash consideration, it could be contingent liability, any type of consideration, it is always included in the goodwill calculation. Okay, if it's a consideration, if it's an expense, then it is in the profit and loss account. Okay, which is 18 million because 3 into 6. Okay, out of this 3 million is for the share capital and the balance 15 is in the share premium. Let us again see the figure. You see, they have exchanged 1 share in Poland for every 2 shares. That's why we are taking half of 6 million, and which is into 6. They have already given the price. So that means 3 into 6. And here if you see the statement of financial position, equity shares is at $1. So that means 3 million shares will be at 1. So it will be 3 million is for the share capital and the balance 15 is for share premium. Okay. Next we have cash consideration. This also should be included in the goodwill calculation at the fair value of 7.5. 6 million shares we have and into 1.25. Okay. Because they told that plus 1.25 per acquired Sonia share in cash. Okay. So if you see, the market price of the share is 6 that day. So 6 into 1.25. So it will be 6 into 1.25, hence 7.5. What about that 1 million professional fees that which they have taken it as consideration? It's an incorrect treatment. So it has to be written off in the statement of profit or loss. Okay. Because the current treatment is incorrect. Coming to the fair value of net assets now. Once you have got the consideration right, next is net asset. Net asset also at fair value you have to calculate. Okay. How are you calculating the before you calculate the fair value of net asset of the combined company, in the individual financial statements, what is their carrying amount of net asset that you have to find out. So in the Sonia's statement of financial position, that means her individual financial statements, the net asset at acquisition is 20 million. 8 million of share capital plus 12 million of retained earnings. Okay, let us go here. If you see here, it is this 8 that you have to take from Sonia and this at the date of acquisition. Okay. So 8 and 12, 20. But what about the brand name which she had? Sonia's brand name is an identifiable asset because you can sell it separately, the brand. So this also must be included in the consolidated financial statements at the fair value of 2 million. Okay. So now with this 20, you have to add another 2. Hence 22 will be the fair value. And this has to be this will not be amortized because it has an indefinite useful life. But it should be reviewed annually for impairment. So if you see here, you to see the brand value was at a fair value of 2 and it has an indefinite life. So not amortization, but annual impairment you have to review. Coming to NCI. NCI also, it is the group's policy to measure it at fair value in this case. And how are you going to measure that fair value? 2 into 3.25. You see, they told that for this purpose, the share price of Sonia should be used. What is the share price of the Sonia at the date of acquisition? It is 3.25. 3.25 into 1 share in Poland for every 2 shares in Sonia. So into 2. 3.25 into 2. You will be getting NCI. Okay. Which is 6.5. This also will be there in the goodwill calculation. Okay. And also NCI will come within equity. So what's next? Calculate goodwill, right? Share exchange, we have got 18 million. Cash paid was 7.5. That means that is the cash consideration. Now you have to add NCI, which is 6.5, deduct the net asset, which is 22 million. Okay, and hence this is the goodwill at acquisition. Now, impairment. This must be reviewed annually for impairment. Okay. Now, since we have valued the NCI at fair value, that means that impairment you should allocate it with among the parent and the group and the NCI. Okay. So you don't have to gross it up. No grossing up is needed when it's a fair value. Okay. So goodwill as above only 10 million. Then net assets will include share capital, return earnings, profit for the period, and brand. Brand is 2 million, profit is 5. Okay. And this is the total carrying amount. Recoverable amount is given as 32.4 million. And hence this is the impairment, 3.8. Right? But before going to this, we'll go through this. See, in the Sony statement, share capital and return profit as it is. Brand is 2 million. Okay. Profit for the year, 5.8 million. We'll see that. If you see here, it is this that you have to take. Okay. So once you are taking the net asset, okay, the carrying amount will be goodwill plus all the net assets, which will give you the carrying amount. Next, after you are doing the impairment, don't forget to write this paragraph. Even in your main answer also, SBR, it's very much needed. Because you have to allocate this among the group and the NCI. Okay. So because the impairment loss is 3.8, it will reduce the goodwill from 10 million to 6.2. And this loss will be charged in the profit and loss. Okay. So 75% will go to the parent of that impairment loss, which is 3.8. And 25% will go to NCI. Now we are coming to the other who is not a subsidiary but he is an associate. So we have to use IS 28 for that. Okay. And it is presumed that they have significant influence. That means Akther is an associate and we have to use equity accounting in the consolidated financial statements. So how are you going to use equity method? How are we going to recognize it? First you have to find the cost. Initially recognized the cost. 8 million into 30% into 7.5. It's very clear, right? Finding this cost is very easy. If you see for Akther, okay, you have acquired 30% and the cost, okay, 7.5 per share in cash. So 30% into 7.5 into 8. You have to go up and see. Just give me a time. It is into 8 million. Okay. Because the 7.5 per share in cash. So if you see here, okay, per shares in cash. Here. I'm just finding out that 8 million. So that 8 million shares only you have to take from the statement of financial position of Akther. Okay, that 8 million you have to take, which will be 18 million. Now, Poland will account for its share of Akther's post-acquisition profit. Okay, so for out of the 10 million, 30% is for associates. So this is the amount that will go to Poland that you have to recognize as post-acquisition profit from associate or associate share of associates profit. Okay, and this will be credited to profit and loss. It's a profit, and debit to investment in associate, because when you're writing in the statement of financial position, you're not writing investment in associate. It will be removed. So the investment in associate will therefore be carried in the consolidated financial statements at 21 million. How? 18 is the cost and plus this 3, the post acquisition profit. Coming to C. So extracts, you add both because they are subsidiaries, but not the third one. Others you are not adding, only the subsidiary. And goodwill, you have to deduct the impairment from this, and goodwill also you have to recognize. Then intangible assets 2 million, the brand, and then investment in associate, which is 21 million. Only the extracts for non-current assets was asked. So you don't have to make the full this thing. Okay. And before I end, let us take this 10 million. Which 10 million are we taking? We are taking this. Okay. This 10 million. Not on this 22 million. We are taking 30% on this 10 million. So the last question. Test understanding 14 fish. On 1st of January 2001, Fish acquired 80% of ordinary shares of Lobster. That means it's a subsidiary. Okay, and they have calculated goodwill at 40. But there were some number of errors that they have discovered and they want some advice now. No entries have been posted in respect of contingent cash consideration that will be paid in 2005. When did they acquire? 1st of January 2001. That means after 4 years they are going to pay this. If Lobster meets profit target. The contingent consideration had a fair value of 4 at acquisition and calculated using a discount rate of 10%. No fair value adjustments have been recorded in respect of their non-depreciable land. This land had a carrying amount of 2 and fair value was 3. Their brand is internally generated and has not been recognized in the consolidated financial statements. At acquisition, the fair value was 5 and remaining useful life was 5 years. Now, the policy is to measure NCI at fair value. And this was correctly calculated and included in the goodwill calculation. So now discuss how the above 3 issues will be accounted for in the consolidated financial statements. You can ignore the deferred tax. And also you have to correct any error. If you have to provide the adjustments that are required to correct any error. A typical exam scenario question. Okay, so let us go first one. Contingent consideration. Okay, where should this go? You should include this or not in the goodwill calculation. This should be included in the goodwill calculation. At what fair value? And when you are adding this will increase the value of the goodwill by 4 billion. How by 4 billion? Because the consideration had a fair value of 4 million. Okay. Also, a non-current liability should also be recognized because contingent consideration, it is something to be paid in the future if you have made profit in 2005. So you are not paying now. In the future, so it's a non-current liability. Today you have to recognize it. Okay. So you debit goodwill because goodwill will increase, and you have to credit liability. Liabilities also will increase. What about the discount part? You have to discount it, right? So the discount on the contingent consideration should be unwound over the year. So on that 4, you are taking 10%. This is a finance cost and it will go in the profit and loss. And this will increase the carrying amount of the liability because it's like an interest on a loan you are taking. Non-current liability is like a loan and finance cost is like an interest. So that should be added with that 4. So it becomes 4.4. So what are you going to do? Debit finance cost and credit liability, because finance cost will increase, liabilities also will increase. Now we are going to the second one, land. Land is a part of a net asset. It should be measured at fair value. So you have to uplift this by 1 million. And net asset increases means goodwill will reduce by 1 million. So you debit property, plant and equipment because it will increase, and you credit goodwill because goodwill will go down. We'll see that 1 million for land. It was 3. This is the fair value, but at acquisition it was 2. You have to take the fair value, so you have to increase by 1 million. Okay. Next, third is the brand. This is an identifiable asset. Okay, so you have to consolidate at fair value of 5 million. That means it will reduce the goodwill because this comes as a part of an asset, right? Under net assets, so it will reduce goodwill. That's why you debit intangible assets and you credit the brand. Sorry, the credit the goodwill. Just see, it is 5 million. But what about amortization? We have to amortize it. It should be amortized over 5 years. So this is the amortization charge. It will be going in the profit and loss, and it will reduce the carrying amount of the brand to 4 million. Okay, so you debit profit and loss and credit intangible asset. Now, of the total 1 million expense, okay, 0.8 will go to the owners of the parent and 0.2 will go to the NCA. Even this expense also you have to attribute with among the parent and the NCA. Any type of expense you have to allocate it between the owner of the parent and the NCA, 80 and 20%, whether it is an impairment and all, or amortization also. Okay, coming to goodwill. So what would be the total goodwill now? And also this goodwill should be subject to annual impairment review. But before that, what is the goodwill? So since there are some errors, whatever goodwill has been given to you before, you start with this 40 and then you keep adding and deducting. Okay, if you see under the first one, debit goodwill, so you have to add 4 million. Okay, then under second one you have to minus 1 million because you're crediting, and third one you are crediting 5 million, so minusing 5 million. So what are you doing here? From 40 you add 4, you minus 1, you minus 5, so 38 is your goodwill. Okay, so that's it. Now let me summarize what all I have covered in all these 3 parts of IFRS 3. Let me zoom this out for you. Okay, so we have started with group structure. This is like a revision of group statement of financial position. You always start with the group structure, then the pro forma is there. Second working is your net asset, third is goodwill, fourth is NCI, fifth is your reserves, your retained earnings, sixth, seventh could be if you have some provisions, if you have some unrealized profit or some intra-group balances that needs to be eliminated, those things. Okay, and some additional workings might come. For example, if you have anything to do with deferred tax or anything like that, it depends from question to question, but this 4 or 5 is always there. Okay, NCI, goodwill, net asset, these are always there. So follow workings 2 to 5. Second, revision of group and OCI. There also same, we have to follow group structure, then pro forma and adding, and this you have to split. Okay, profit and the TCI split. Then we had associate. Associate, we are using equity method. That means the cost of the equity, the cost to buy the associate plus the profit, right? The associate's percentage multiplied by the post acquisition profit. Control. Then we went through IFRS 10. Okay, this was IS 28. Okay, so control, we talked about these 3 things. They should have, the investor should have power over the investee, they should have the right to variable returns, they should have the ability to use the power. It does not matter whether they exercise their power or not, but they should have that ability. Then we went through acquisition method. Who is the acquirer? We identified the acquisition date. All these 2 things is not needed for SBR. Okay, for us it starts from here. identifying net assets, goodwill, NCI. Then we went to impairment of goodwill. And how to gross up goodwill use if it was prepared under proportionate method. Then we went through joint arrangements, okay, which is dealt under IFRS 11. And this also you need the help of IS 36 impairment, okay, and this is your IFRS 3. Joint operations versus joint venture. If it's joint venture, then you have to use IS 28. Same method, equity method like associate. And if it's joint operation, then you have to deal according to IFRS 11. So that's it. These are a few things that we have covered so far. So with this, I have covered all my standards in SBR. What else is remaining is step accusation, disposal, and some more group questions, some more scenarios to group accounting. For example, if it's a foreign subsidiary, then how to translate and consolidate, right? If you're buying in between the year, if you're disposing, then how to calculate all those things. But the standard, there is no new standard. The standard which we have studied, IFRS 10, IS 28, IFRS 3, all the standards that we have learned, we can apply there. Okay, so I'm going to cover those as well in the upcoming few videos, 2 or 3 videos, and then I'm done with SBR syllabus. Okay, so till then, see you in the next video, and don't forget to subscribe to my channel.